Okay, welcome to today's webinar. Ebuka Ambrose here, and I'll be talking about the fundamentals of Forex trading, which is the very basics, right? It's very important that you get the knowledge of the basics of Forex because it's going to help you and it's going to play a huge role in your journey to be a profitable trader. Before we go into the content of this training, I would like for you guys to type in the comment box or the comment section wherever you're joining us from, your name, what state, and what country you're joining us from. And in the course of this training, if you would have any questions, you can put them down in the comment section. I would constantly check to see if you have questions and I would answer them. So let me know where you guys are joining us from. Okay, we have Chukwemeka Ugochukwu from Nigeria. We have Thomas Andrew from Ibadan. Welcome, Thomas. Welcome, Chukwemeka. We have Ashley from the UK. Hey, welcome, Ashley. And okay, without further ado, I'll just go into the content of today's training. Okay, wow. We have Damilare from Nigeria. We have Kazim Yusuf from Nigeria. We have Skills. And we have Ron Greenwood from South Africa. Massive welcome to you guys. Okay, if I go on with the names, we wouldn't get to today's training. So welcome every one of you. We're going to start with the definition of Forex. I know a lot of you guys have been hearing Forex everywhere, and you'll be wondering what it means. Forex is the short form for foreign exchange. So it's two words that come together to form the word Forex. It's sometimes abbreviated by FX. Now, the FX market is a global decentralized market where the world's currency change hands. Exchange rates change by the second, so market is constantly in flux. The foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world with a 6.6 trillion total daily liquidity. What this means is every single day, every single trading day, there is $6.6 trillion available for you to, profit from as a trader. Okay. Okay. How are transactions carried out in the Forex market? It's really simple. When trading the Forex market, you're buying or selling the currency of a particular country relative to another currency. There is no physical exchange of money, just like you do in maybe the bank or an exchange office or kiosk. There is no physical exchange of money. Okay, so in the Forex market, a currency is always traded relative to another currency. If you're selling a currency, you're buying another currency, and if you're buying a currency, you're selling another currency. In this illustration here, you have a trader and you have the euro. Now, this guy, if he goes to the bank to change his euro for dollars, he's going to sell his euro to buy the dollars from the bank or the broker. So what we are doing in the Forex market is we are constantly transacting and exchanging currencies without going to the physical bank. Okay. All right. Check in the comment section to see if you guys have questions. So if you're just joining us, welcome. If you have any questions, you can just type them in the comment box and I'll be checking constantly. Okay, who is a Forex broker? Now, a Forex broker is a link between a trader and the network of banks that have access to Forex liquidity. The Forex broker gives you access to foreign exchange trading and provides support functions for you. Let me use myself as an example. So let's say I'm a skilled footballer, right? I know how to play football, and I want to play against major leagues, I would have to join a club that would give me access to, play against major leagues generally worldwide. So that's where the brokers come in. They give you, they provide a trading account for you, and then they give you access to trade on the financial markets. You make your deposits to the broker, you make your withdrawals to the broker. And talking about brokers, if I'm to recommend a broker for you, I would recommend OctaFX for you guys. And a lot of you might be wondering why OctaFX. First of all, before I give you the reasons why I am recommending OctaFX, I need you to know that they've had 10 years experience in the industry, and 10 years is a whole lot of time to improve, to know what traders want and traders don't want. 10 is a whole lot of time. Now, the first one is they offer the lowest spreads. In the course of this training, you'd understand the meaning of spread and why you should take advantage of this offer. The second is trade execution speed. You don't want to get caught up in slow trades where your trades are going to be executed at the wrong time. So that is why I'm recommending OctaFX, because they offer good and fast trade execution speed. No deposit or withdrawal fee. You can literally deposit and trade and withdraw your profit without having to pay any extra charges. Local transfer. So for those of you in Nigeria, you can easily do a local transfer to deposit funds into your trading accounts without having to go through all the stress of creating a domiciliary or a dollar account and all that stuff now. And then they also have amazing offers and bonuses, which I'll also let you guys know about. Okay. All right, so we're moving to currency pairs. Currency pairs. This is a really important thing to take note of while trading, because most of the instruments that you trade in forex markets are currencies. Now, a currency pair is the quotation of two different currencies with the value of one being quoted against the other. Now, a currency is just like a pair of shoes, right? You have the left leg and the right leg. They come together to make a pair of shoes. So you cannot call just one currency a pair. It has to be quoted against another currency to form a currency pair. For example, like so you have here, you have the Euro USD and you have the AUD JPY. I'll tell you what these abbreviations mean in the next slide. But for now, it's important that you know that in a currency pair, the first currency is called the base currency, and the second currency is called the quote currency. It's also important that you know that the first currency, which is the base currency, is always greater than the quote currency. Okay, so the first currency is the base currency, and the second currency is the quote currency. Now, the price of each currency is going to tell you the amount of the quote currency you would need to get the base currency. For example, you have AUD JPY is valued at 83.55. Now, this means you would need 83.55 worth of Japanese yen to get $1 Australian dollar. Okay, so you'd need this. You would need 83.55 worth of Japanese yen to get $1 Australian dollar. If you have any questions concerning the currency pair, you can type them in the comment section and I would answer them. Okay, so we have various currency pairs in the market. We have over 50 currencies in the forex market that you can trade from. But this is what a currency pair looks like. So these are the abbreviations. EUR is for euro, and you have USD for dollar. You have GBP for the Great Britain pound, and CHF for the Swiss franc. You have the AUD for Australian dollars. You have CNY for Chinese yuan. You have the Japanese yen, the South African rand. You have the Canadian dollars, and you have the New Zealand dollars. There are a lot more of these currencies that have been traded in the Forex market. But for now, this is what it looks like, and this is what a currency pair looks like. So the currency pair is just two currencies coming together to form a pair, and then every single trade that you place on each of these currency pairs, you're placing them at or on the base currency against the quote currency. So for example, if I'm to place a buy on Euro USD, that means I'm buying Euro USD to sell. I'm buying Euro to sell USD rather. So if I'm to place a buy on GBP USD, I'm buying GBP, which is the Great Britain pounds, to sell USD. Now, if I am placing a sell, I am selling GBP to buy USD. So whatever thing that you do, whatever action or whatever trade that you place in the market, it's acting on the base currency. Okay, so if you sell this, if you sell Euro USD, that means you're selling Euro to buy USD. If you buy Euro USD, that means you're buying Euro to sell USD, right? Okay, I think that's pretty understandable. The next thing we'll be looking at is the bid and the ask price. Now, the bid price represents the price at which the Forex broker is willing to buy from you the base currency in exchange for the counter currency, and the ask price is the price at which the traders are willing to sell to you the base currency in exchange for the quote currency. So if you open your trading app, you're going to see that the prices are different. They are, differentiated by two lines. Now, the first one, which is the one above, is called the ask price, and the second one is called the bid price. So if I am to place a trade, a buy trade on this is Euro USD, right? So if I am to place a buy trade on Euro USD, it's going to be executed at the ask price, and if I'm to place a sell trade, it's going to be executed at the sell price. You cannot buy and sell at the same price. It's just like you have the banks when you're going to trade your money. If you're trading euro for US dollars, the banks would buy at a different rate and they would sell at a different rate. Okay, checking to see if you guys have questions. No question. Okay, all right. Now there's something that is called the spread in Forex, and the spread is the difference between the bid price and the ask price. So like I said in the previous slide, you have the ask price where traders are willing to sell, and you have the bid price where traders are willing to buy. So what I mean by traders are willing to sell is when you place a buy trade, you're buying at where someone is selling. Okay, and then when you place a sell trade, you're selling for someone to buy. Okay, so the spread is the difference between the ask and bid price. If you look at this red line and this blue line, you're going to see a small space. It's actually the difference, like it's the ask minus the bid. So that's the spread, and the spread is often where brokers make their profit for every trade that is being executed. Okay, that's why most times every time when you place a trade, you automatically be at a minor loss. That's the spread. That's the spread talking. But yeah, to further explain what the spread is, if you look at the Nigerian currency, for an example, it's valued at 410 to $1 for buys. Now, if you go to the bank and you want to sell your dollar, if you have $1 and then you're going to the bank to sell your dollar, the bank has this fixed rate to buy from you. So they are buying from you at 410 and they are selling to you when you want to buy at 415. So if you look at these two figures, these two prices, there's a naira difference in the prices, and that is where the banks make their profits from this transaction that is being made. Okay, so when I talked about the broker, this is exactly how it works. So they buy from you at a different rate, they sell to you at a different rate, at a higher rate. Okay, yeah, I think that's understandable. If you have questions concerning the spread right now, you can type in the chat box, and I'll answer them. At any point in time you have questions, just type them. Okay, we're looking at pips and points. What is a pip? A pip is a short for percentage in point or percentage in profit. Now, it's also called price interest points. A pip represents a tiny measure of the change in currency pair in the Forex markets. This is represented by a single digit move in the fourth decimal place in a typical Forex quote. I would explain what I mean by typical Forex quote, but I just need you to know that currencies move in, it's just like the movements in price, the movements in a quote, a pair, whatever. It could be Euro USD, it could be AUD USD, any currency pair, whatever you're trading, they move in pips. Okay, and they're also calculated in pips. So if you're to calculate your profit or calculate your loss, it's going to be calculated in pips. And this is an example of a typical pair. You have Euro USD, you have AUD USD. Like I said, when the class started, Euro is for Euro, EUR is for Euro, and then USD is for the US dollar. So it's really important that you get familiar with these abbreviations so that you don't trade without knowing what you're trading. And then you have the Japanese yen pairs, which is every pair that is associated with the JPY. And then you have the gold and silver pairs. Now, each of these Forex quotes have different ways of calculating them, which we're going to look at right now. So for the typical pairs, where you have the USD and the Canadian dollars and Euro and New Zealand dollars, they are calculated by, or their calculation is started from the fourth digit after the decimal point. Okay, from the fourth digit after the decimal point. So if EuroCard is valued at 1.4705, just like it says here, and remember, whatever value you see of a pair, it's telling you how much of the quotes you need to get one of the base currency. So it's telling you how much of Canadian dollars you would need to get 1 euro. Now, if this currency pair is valued at 1.4705 and I am to buy this currency pair and I want to make a profit of 10 pips, all I do is to add 10 here. So it's pretty easy. Now, one single pip is valued or is calculated by 0.0001. Okay, now as I'm adding 10 pips, that means I'm calculating by 0.0010. Let me put up my calculator and okay, so EuroCard is valued at 1.4705, right? And remember, 1.4705, right? And I am to add 10 pips. Remember, 1 pip is 0.0001. This is 1 pip move. That means if it moves forward, or if it moves in profit in my favor, 9 pips, then it's going to be 0.0009. Now, since I am looking to take my profit at 10 pips, it's going to be 0.0010. I add that and I get my profit point, which is 1.4715. The same goes for NZD/USD. If I'm to hop on a sell on this particular currency pair, NZD/USD, which is valued at 0.7045. I'll do the calculation again. 0.7045. Okay, 0.7045. Right now, if I'm to place a sell, and it's important that you know that you're calculating buys by adding the pips. So if you're buying a currency pair, if you're buying a particular currency pair and you want to make profit from the buy, you'd have to add the amount of pips you want to make profit, and you get your take profit points. Then if you're selling, you subtract to get your take profit point. So you don't sell and add to get your take profit point. No, when you sell a currency pair, you subtract how many pips profit you want to make from your position, and then you get your take profit point. So if I'm looking to sell NZD/USD, which is valued at this, and I'm taking my profit at 20 pips, then I am going to sell. So if I'm subtracting, remember, 1 pip from a typical Forex quote is valued at 0.0001. And now I'm subtracting 20 pips. So simple, I go to minus, I do 0.0020, and this 0.7025 is going to be my take profit point for the sell for the position. The same thing goes for this. Now I'm going to quickly move to the Japanese yen, because the calculation is different. Now the calculation for Japanese yen starts from the second digit after the decimal point. A typical pair starts from the 4th digit after the decimal point, but the Japanese yen starts from the 2nd digit. Now if GBP/JPY is valued at 153.18, which is telling us that you need 153.18 worth of Japanese yen to get 1 Great Britain pounds. If it's valued at this, and I'm buying the pair to take profit at 10 pips, simple. I just add 10, 0.10 to 153.18. Now, if I'm to take profit at, I'll put on my calculator. If I'm to take profit at, so 153.18. If I'm to take profit at 9 pips, then I'm just going to do plus 0.09 if I'm to take profit at 9 pips. But since I'm taking profit at 10 pips, then I'm doing 0.10 equal to. So this is going to be my take profit level for GBP/JPY on a buy position, right, for 10 pips. So it's simple. The same thing goes for AUD/JPY. If I'm to sell AUD/JPY, which is valued at this, and I put my take profit point to 32 pips, all I do is, remember, you start your calculation from the 2nd digit after the decimal point, right? So AUD/JPY is valued at 83.55, right? Let me check, see, yeah, correct. And I am on a sale, right? Remember, when you're selling, you're subtracting to get your profit. When you're buying, you're adding to get your profit. Okay, so I'm subtracting, because I want to take profit at 32 pips. I'm subtracting 0.32. I do equal to. So this is going to be my take profit level for AUDJPY on a sell position at 32 pips. Okay. So for Canadian, for CADJPY, which is the Canadian dollars against the Japanese yen, if it's valued at 89.55, checking to see if you guys have questions. Okay, if it's valued at 89.55 and I am to take profit at 25 pips, what is going to be my take profit level? If you know the answer to that, just type it in the chat box right now. So if Canadian dollars against the Japanese yen is valued at 89.55 and I'm to take profits at 25 pips on a buy, what is going to be my take profit level for 25 pips? Okay, Kazim said 89.80. Atta Ikeri said 89.80, and they are both correct. It's pretty simple. Remember, you start your calculation from the second digit after the decimal point, and you have 25 pips, right, as profit for a buy. All you do is go to your calculator. It's valued at 89.55. If you're taking profit at 9 pips, all you do is you add 0.09. The reason why I'm using 9 is because it's a single digit, so you don't get confused. But since we are taking profit at 25 pips, which is 2 digits after the decimal point, all you do is 0.25, 89.80. Oh, somebody said 89.20. No, you'd have to do your calculations correctly. Remember, you're calculating from the second digit after the decimal point, so you'd have to do it correctly so you can. Yeah, all right. You have the gold pairs, and it's also, the gold pairs also have a different method of calculating them. You start your calculation from the first digit after the decimal point. Okay, so the first example is gold XAUUSD, and it's valued at 1775.9. Now, if I'm to take profit at 10 pips, it's valued at 1775.9. I'm correct, yeah. So if I'm to take profit at 9 pips, remember, first digit after the decimal point, I'll just do 0.9. But now I'm taking profit at 10 pips. So what I'm going to do, instead of 0.9, since it is 2 digits now, I do 1.0. 1776.9 is going to be my take profit level for XAUUSD 10 pips on a buy position. Now, if I'm going on a sell, like I told you, when you're selling, you're subtracting to get your profit level, and when you're buying, you're adding to get your take profit level. So if I'm selling this and I want to take my profit at 15 pips, all I do is remember the value. XAUUSD is valued at 1775.9. Taking my profit at 15 pips. If I was taking my profit at 5 pips, I'll just do 0.5 minus 0.5. But I'm taking my profit at 15 pips, 2 digit, right? So I do 1.5 instead. 1774.4 is going to be my take profit level for 15 pips on a sell on gold. Now, this one is for you. If gold is valued at 1775.9 and you're taking profit at 35 pips on the buy position, what's going to be your take profit level? So gold is valued at 1775.9 and you're taking profit at 35 pips on a buy position. What's going to be your take profit level? Ooh, I think this one is a little bit hard for you guys. I had difficulties with calculating gold when I started trading. Like, it took me a lot of time to understand. Israel said 1779.4. Do we have any other answers? Okay, to make it easier for you guys, now remember it's valued at 1775.9. You're taking profit at 35 pips. It's simple. Calculation for gold starts at the first digit after the decimal point. 35 is 2 digits, right? So you do plus 3.5, 1779.4. That's going to be your take profit level for gold on the buy position for 35 pips. I think, okay, we have multiple answers now, so I think it's understandable. Malcolm, you need to get your calculations correctly because your answer is wrong. Calculate gold from the first digit of the decimal point. Okay, so you're moving to trading times and sessions. When do you trade Forex? Now, each of these sessions the names are derived from cities in which major or most of the transactions in these currencies are done. Just like the Sydney session represents Australia, and then you have Tokyo, which is sometimes called the Asian session, represents Japan and some of the Asian countries. You have London, which represents the UK and the countries within the UK, and you have the New York session, which represents America. Okay, now it's really important that you know that every trading session lasts for 9 hours, and all you have to do is, if you know the opening session or the opening time for your session, you just add 9 hours to get the closing time for that session. The Forex market is open 24 hours 5 days a week. It's not open 24 hours 7 days a week. In Nigerian time, it opens by 10 p.m. on Sundays and closes by 10 p.m. on Fridays. Yeah, every single time that is listed in this illustration is in Eastern time. So you do your appropriate calculation depending on your time zone to know which session you're currently on. Okay. I think if the market is opening on Sunday by 10 p.m. in Nigerian time, then I think it's going to be 5 p.m. in Eastern time, right? Yeah. If you have questions concerning trading times and sessions, you can drop them in the comment section. I'll be checking to answer. Now, these are some keynotes that you would need to. These are some keynotes that you would need to know about trading times and session. Like I said, every session you see here, every time you see here is listed in Eastern time. So all you can just do is check word calculator to know, okay, 4 p.m. Eastern time is what time in your location, and then once you get it, you add 9 hours to get the closing time. Simple. Okay, the first keynote is, other than the weekends, there are just 2 public holidays when the entire Forex market is closed: the Christmas and the New Year's Day. So at these 2 days, the Forex market doesn't function. The second one is, opening and closing times are based on local business hours, with most business hours starting somewhere between 7 to 9 a.m. local time. Okay, so if you're wondering why the Forex market or a trading session is opening at maybe 12 a.m. in your country's time, it's because that is the opening business hour in a different country. The third one is the Forex markets opening and closing hours will change in March, April, October, and November as countries move to daylight savings on different days. The main reason for daylight savings or DSCs so that the afternoons can have more daylight and the mornings can have less daylight. Okay, the clocks are adjusted forward 1 hour at the start of spring and are adjusted backwards at the in autumn season. Okay, the fourth one is it's important to trade when at least 2 sessions are open because markets tend to be volatile at that time. Now, if you're trading the Forex market, you don't want to trade a quiet market. Okay, volatility is just the measure of the amount that a price fluctuates within a given period of time. So if a price is moving wildly in any direction, it could be up, it could be down, it could move both ways wildly, you can call the market a volatile market. It's not compulsory that you trade when it's moving so fast, but if it's moving at usual speed, then you can call that a volatile market. And volatility is what gives you money as a trader. If you trade a quiet market, it's going to take a lot of time for market to move in your favor or move against your favor. Okay, so markets get or tend to be volatile when 2 sessions are open. For example, remember this is Eastern time, so 4 p.m. to 1 a.m. the Sydney session is going to be open and functioning. That means currencies in this session are going to be tradable. Currencies in the Tokyo session, the Japanese yen, are also going to be tradable because the Tokyo session is opening at 7 p.m., which is 3 hours ahead of 4 p.m. At this time, at 7 p.m. or at 8 p.m., you'd also be able to trade the Sydney session and the Tokyo session at the same time. That's what I mean by it's good to trade when 2 markets are open because markets tend to be volatile. Okay, advantages of the Forex market. The first one is high liquidity. Now, the Forex market is said to have high liquidity because of the volume and the frequency at which it is traded. Okay, there are a lot of buyers and there are a lot of sellers constantly in the market. You don't really have, and that's why your transactions, your positions, your trades are executed instantly. You don't have to execute a trade and wait for 5 minutes for someone to maybe you're executing a sell trade and then you don't have to wait for 5 minutes for someone to come and buy at a price. No, it's instant because there are a lot of participants in the market. That's why it's said to have high liquidity, and that's a good advantage. Positions are opened and positions are closed at speed, okay, instantly. The second one is time flexibility. What I mean by time flexibility is at some sessions you could be at work. Okay, for those of you that work, at some sessions you could be at work. At some sessions you could be in school. But that doesn't mean you can't trade the market because when you get back home, okay, for example, let's say okay, let's use New York session for example. Let's say you have a job and your job is from 9 a.m. to 5 p.m. You may not have time to trade the New York session, right? But when you get back home, you would be able to trade the Tokyo session and the Sydney session. So it helps you work on your schedule and work on your trading time so that you can know when to hop on the market. So you don't get there's nothing like you being left out of the market. It doesn't close, so you can just come and spread out your time, know when it works for you, or when it's a good time for you to trade and when it's not a good time for you to trade. The third one is volatility. Like I said, is the measure of the amount at which a price fluctuates within a given period of time. So the markets are constantly moving and they're constantly fluctuating. They give you an opportunity to take advantage of the movement. Okay. The fourth one is you can trade various instruments. You can trade over 50 currency pairs in the market. It gives you different options. You don't really have to trade all the currency pairs. You can just pick the ones that you like, practice, know how to trade them, and then you see a lot of people having favorite pairs. For me, my favorite pair is the Great Britain pounds against the Japanese yen. So the Forex market gives you an opportunity to choose among various pairs and trade. The fifth advantage is zero or minimal commissions. Or when you want to make deposits or withdrawals to your trading account, you don't get charged. OctaFX doesn't charge you for deposits and withdrawals. Minimal commissions here can be for ECN accounts or swap fees overnight. When you leave your trades open overnight, you get charged minimal commissions. And by minimal commissions, I mean below 10 cents. Compared, it depends on your lot size. So but the commissions are really minimal. Okay, the sixth one is leverage. Now, leverage is just having the opportunity to trade a larger amount of money and make huge profits with your personal small money, with your small cash. Okay, now it gives you like an advantage where you can make profits that you wouldn't have made without leverage, and the brokers offer leverage. Okay, the seventh one is, which is the last one, is free practice and demo. This is my favorite. I'd call it personally. I'll call it the best advantage because it's really helped me, improve on my skill. Now, it's important that before you start trading, you take advantage of the demo account. You practice, you backtest everything you've learned, and before you start moving to a live account. And this advantage is really good because you don't have to just start trading with your money. Or you can register a demo account for free. If you don't know what demo is like prop. It's like fake money. It's not really money you can withdraw. You can trade it, you can make profits, but you cannot withdraw your profits because it's not real money. So you're just using it for practice, and it's free. So it's really an interesting advantage. Now, talking about demo accounts, we'll be looking at how you can create a demo account with OctaFX. But before I go into how you can create an account with OctaFX, does anybody have questions concerning today's webinar? You have the comment section to type your questions and I'll answer them. This is going to be like a wrap-up for the webinar today. Okay, just to be sure, if you can hear me, let me know in the comment section if you can hear me right now. Okay, so Ichichuku Michael says, how do one create a free practice or demo account? Yeah, I was about to do that. So all you have to do is go to your browser and type OctaFX.com. Now you're going to see this website. It's going to pop up, and then you'd click on trade with us or open account. Any of this is going to bring out a new window where you can create an account. Okay, so I'm just going to go ahead and create a demo account right now. Do that quickly. Okay. the and also something about a demo account is about signing up for a demo account is you can sign up with Facebook, you can sign up with your Gmail or your Apple account. Okay, so password, check if you're not a robot. Okay, Prince says, can one use a phone for trading or must it be a laptop? You can use your phone to trade. It mustn't be a laptop. Okay, successfully signed up. I have to go check our mail. So I'm just going to refresh this mail right now. See. We've gotten a message from OctaFX. Okay, open Gmail. Oh. Okay, I'm not really sure how long the mail takes to arrive in your inbox. Okay, Berlus Daniel says, is it possible to have a double trading account? You can have one account and have you can just create a general account and have trading accounts under it. I don't really think you can have multiple accounts. I don't know about that. Do we need to download the app or it's yeah, you should download the OctaFX app, trading app, to have or to get extra features. Okay. So I'm just going through the quick link, the quick Google link, and taking me to this point where you have to put your password and then city, street address, and phone number. Yes, I've traded Forex before. And then okay. For some reasons, I would not be able to put my phone number right now. Not sure if it's going to let me pass through this stage without putting all this, but after this point, you just have to, it's going to take you straight to your dashboard. Yeah, I guess. So how long? Okay, so that's it for today's webinar. I'm going to use extra 4 minutes to answer your questions and then wrap up. Okay. Wisdom says, is it a must that someone will keep watching his trade till the end of the trade? No, you don't have to. That's why you have your take profit positions where you can just set where you want OctaFX to close the position in your trade position in profit, or your stop loss where you want OctaFX to close your trade if it's going against your position. Okay, I guess that's it for today's webinar. If this is your first time of joining our webinars of OctaFX, I suggest you also check out other webinars because quality content is being given out, quality information is being given out. What we do in these webinars is we teach you and give you information about how to be a profitable trader. So take advantage of these webinars. See you guys next time. And if you still have questions that are not here right now or I can't see, you can type them in the chat box and you'll get replied, or I'll answer your questions in the next webinar. Once again, thank you all for joining, and see you guys next time.